Hey everyone, I'm Troy Williamson with the Wilmington, North Carolina mortgage team here at Cornerstone Home Lending. And today we're going to talk about it's basically the fourth segment of our financing series, if you will, and it pertains to what we call non-traditional or non-QM financing. QM stands for qualifying mortgage. The non-traditional financing is going to be financing options that do not correspond with mortgage guidelines for conventional financing, government, or jumbo. Non-QM or non-traditional mortgages could be, say, an example would be for self-employed borrowers. Instead of using your traditional documents for income purposes like tax returns, we actually use 12 to 24 months worth of bank statements, either personal or business bank statements, to calculate what their income is going to be for qualifying purposes. Another example of a non-traditional mortgage loan is something we call an investor cash flow loan. And that's basically where on an investment property transaction, you essentially use the projected rental income of the property being purchased to ensure that the rental property is going to be sufficient to cover all of the carrying costs on the mortgage. That includes principal and interest, taxes, insurance, and HOA dues as well if applicable. So those are just a couple of examples of non-traditional mortgage loans that we oftentimes use. You also have non-traditional mortgage loans that are geared more towards borrowers that don't qualify for conventional financing or government financing due to a past derogatory credit event that's occurred, such as a foreclosure or a bankruptcy. On conventional and government financing, there's defined waiting periods in which have to occur or have lapsed from the event that occurred until you can purchase real estate again. Whereas on non-traditional mortgage loans, there's some programs out there where you can literally purchase a home with 1 day out of bankruptcy. So there's some flexibilities there that are offered on the non-traditional mortgage side. On the non-traditional mortgage side, you're going to see typically, not always, but a lot of times, higher credit score requirements. There can be much larger down payment requirements. More asset documentation required, and interest rates are traditionally going to be a bit higher than what you would find in the conventional or government or jumbo financing realm, just because they're specialized niche products that are not as plentiful. Law of supply and demand. If there's a limited amount of supply of these mortgage products out there, but there's the demand for them, the few investors out there that are offering these non-traditional mortgage loans can kind of set their own interest rates because they don't have to be as competitive because not everybody's offering them. A lot of times with higher interest rates, you'll also see higher upfront fees associated with these loans as well. At the end of the day, the non-traditional mortgage financing options are not meant to be long-term financing options. It's more of a short-term option to provide a borrower who would not have normally qualified for conventional or government financing, that needs a way to qualify for a property at this point in time, but likely down the road, they're going to refinance out of that mortgage loan into a more conventional loan product with likely a lower interest rate. So there are some creative financing options out there in the non-traditional arena that very well may serve if you've got a specific scenario or situation and you're having a hard time finding a conventional or government financing option that fits your needs. Some of these non-traditional mortgage loans could be the perfect loan option for you at this point in time. As always, we're here to answer questions and help out any way that we can. We look forward to hearing from you, and we hope you have a great day. Thank you.